Welcome to the Risk Reversal Podcast. I am Dan Nathan. I am joined on our weekly dose of Peter Boockvar. He is the CIO at One Point BFG Wealth Partners. Peter, welcome back to the podcast.
Thanks, Dan. Great to be here again.
I'm really digging our weekly, by the way. And you and I were just having a little chat about what might happen within the Boockvar household. Actually, not within it, but you might be heading, I don't know, Giant Stadium, Oasis this weekend. I didn't know you're a big Oasis fan. I know you're a big Dead fan. You've seen some of these videos. It's a little bit of a jump around on the floor. Are you going to be part of that?
I will probably not be jumping around. I'll probably, if I do get seats on the floor, I'll be in sort of a back corner somewhere, but enjoying the vibe. I don't know all of the music. I know a bunch of it. But just watching those videos, what an incredible vibe those shows are giving off. And my wife's cousin took a trip to Scotland to see one of the Edinburgh shows and said it was just a religious experience. So I think I need to be there.
You do need to be there. You know what? I'll go when they come to Madison Square Garden, so I don't have to jackass it out to Giant Stadium and back. But it really looks like a whole heck of a lot of fun. All right, let's hit a few things here. Obviously, this ongoing beef that the White House has with the Fed, Lisa Cook, one of the governors, they're threatening to fire her. And there's a few implications with that. And hopefully you can break that down for me. Nvidia reports tomorrow night after the close. You have some thoughts on just how this whole generative AI build out might affect not just the stock market, but the broader economy. We're going to hit some of your ideas, some of those off the beaten path ideas that we've gotten to know and appreciate from you. And then also maybe what's going on with the regional banks and kind of what's going on with short-term rates versus longer-term rates, because I know there's a lot going on around the world on the long-term standpoint. All right, let's talk about this Lisa Cook situation. You had a great post in the book report this morning. We're recording this Tuesday afternoon around 2 o'clock or so, and we don't have to debate the merits or the accusations against her. I mean, you made the point of, that everyone who's accused of something in our country deserves due process, and we'll see how that shakes out. It doesn't mean that the president, who has the right to fire her, I believe has the right to fire her, can do so before that due process starts. But let's talk about what you think some of the implications are. What are the best case scenarios right now? That they just back off, they let the whole notion of this independent Fed continue to work its way out. The president is getting what he wants. Fed Chair Powell is very likely, the CME Fed Funds Tracker suggesting back to a near certainty of a 25 basis point cut in September. What would you like to see here in general? Because this sort of beef is not helpful to the whole notion of the independence of the Federal Reserve.
Yeah, so to your original point, all I want to see, and the chips will fall where they may with Lisa Cook, all I want to see is the process play out, is the due process, as you said, play out, is let her give her side of the story after she gets charged with something outside of just tweets, and let the process play out. If she deserves to go, then she's going to resign, and then we'll move on. But it's evident that there is a concerted effort to bully existing Fed members, in addition to possibly driving out existing ones, also to replace them with others that are going to be more focused on lowering the cost of money, not because the inflation and growth statistics deserve a cut, but just because the government needs to relieve itself of its $1 trillion interest expense. So that's where things get into more dangerous territory in terms of the lack of independence with the central bank. And it won't be me that's talking and being out there criticizing this. It's going to be eventually the markets. It's going to be how investors view the dollar under that scenario of a third world type central bank that's just doing the bidding of its leader. It'll be the long end of the yield curve that speaks out. It'll be the price of gold that speaks out. And maybe eventually it'll be the stock market that has an opinion on this. But all I'm calling for is a process before we start, playing apprentice and start just firing people because you don't like something they did. Let the legal situation present itself, and then we can go from there. And again, wherever it plays out, if she's got to resign, she's got to resign. But Let's just not, okay, fire her through tweets.
Yeah, and I guess it has a lot to do with the perception of how the administration is working with a body like this that has a great deal of influence potentially on the economy, not just from an interest rate standpoint. They have this massive balance sheet, right, that can be useful under different circumstances. They don't need congressional approval pretty much, right, to kind of implement some strategies that we've seen in the past with that balance sheet. So it's something that you would think that the White House would be very interested in having under its control. But what about the perception that we can just have from the top down in the executive branch, affecting monetary policy like this? It seems to be one of those things that has not happened in this country in a very long time. And it might be one of those things making us look like a less reliable sort of capitalism, if you will. Does that make some sense, Peter?
Yeah, and that's going to be the instance where the markets are going to play judge and jury. And it'll be the 10-year yield, the 30-year yield, it'll be the value of the dollar, it'll be the price of gold that's going to express its vote on whether they like this or not. And also, we have to keep in mind too is that if they get too cute here with cutting short-term interest rates too much, and inflation flares up again, then the strategy is going to completely backfire again. We are in an inflationary world post 2021, post COVID, and it's very easy for that genie to get right back out of the bottle on inflation. And all you need is excessive rate cutting, not again because the data supports it, but because somebody else wants to support it. Then you got a repeat of the 1970s again. So it's easy to say, okay, this is what we want, but actually achieving it without any consequences, I think is going to be much more difficult also to pull off. The other thing, and what gets even more dangerous, is if the Fed governors start to influence, because they do have votes on who the Fed presidents are going to be. So it's not just control of the Fed governors that is being attempted here. If they start going after the presidents, then you have a real tenuous situation in terms of the independence of this institution. So those are things that I'm watching for. Now, Powell is still there till May. There's still time until, in the sense of him being in control. And I want to believe, and maybe I'm just being naive for believing this, that there will be some of those that get appointed will focus on their reputation and will try to do what they think is right, rather than just being a patsy for the administration. Now, maybe again, that's just totally unrealistic to think that. And again, I'm being naive, but I want to think that there is some desire for credibility in this institution with who comes after Powell, and or who fills the seats until he leaves.
Listen, you're not being naive, you're being hopeful, but there's no examples, I think, in this administration over the last, let's call it from the transition to now, so we're only just talking about 9 months or so, where there's been anything but patsies. You know what I mean? And so when you talk about the idea of replacing Lisa Cook with a governor that will do his bidding, right? And then you just made the point, coming after the presidents, you have no reason to believe, based on what Trump has done with the Texas redistricting, that you wouldn't have a very similar situation. But my question is, if Cook were to resign or was replaced because she was fired, what does it mean for the FOMC to have a majority that this president has picked?
Well, it'll be, in a way, it's not going to be that much different than previous committees, in the sense that, based on who's voting, we get certain years where there are more doves than hawks on the committee, and they lean dovish, and there are more hawks on the committee another year where they lean more hawkish. I mean, Bernanke and Janet Yellen kept the Fed funds rate at 0 for 7 years. It's hard to get more dovish than that, on top of all the QE that they've done. So now, I'm not going to say that was necessarily political, even though Janet Yellen, rather than hiking interest rates right before the 2016 election, waited a month after. Politics are played on both sides. So this committee is definitely going to lean more dovish. There's no doubt about it. And the real question is, are there going to be sort of market-driven guardrails to the extent at which they can be dovish? And I mentioned earlier, the long end of the curve, price of gold, the value of the dollar. Or is inflation going to be sticky enough, even if we get further weakness in the labor market, which I think is going to happen, will they be able to get away with too many rate cuts if inflation's stuck at 3%? They'll try, but then they start playing with fire, because if you get a rise in long rates, if you get a notable weakness in the dollar that leads to an acceleration in oil prices, for example. And like it's much easier said than done to say, okay, I'm going to get into that seat. We're just going to cut rates and everything is going to be fine. There are a lot of potential potholes from here until there.
The dollar doesn't get out of its own way, and it really feels like the 10-year is about to come in pretty hard. I know what you've, think about the 30-year. But Peter, last question here before we move on. What do you think, some of the trade-offs are? Lowering interest rates to get that $1 trillion debt service down, right? But risking the potential for inflation, as you just mentioned, to get stoked higher again, because I get it. You know what I mean? That $1 trillion in interest expense is greater than our defense spending, like a whole host of other things. But how do you weigh those two things? Because again, that huge deficit it weighs on growth, right? But the potential of inflation going higher would also do that.
Well, it's interesting. The deficit also in certain ways stokes growth in multiple ways. Number one, all that government spending is flowing into the private sector. And interestingly enough, that interest expense of the government is somebody else's interest income. Now, 30% of that interest income is going to foreigners, but 70% of that interest income is staying here. And when you want to tie this into the economy, there's this very simplistic belief on the part of many that low rates good, high rates bad. Well, if you're a boomer that's loving their cruises every couple of months and using the interest income that they're deriving to pay for it, well, lower interest rates cut into their interest income that can then negatively impact their consumer spending. And we know a nice chunk of the consumer spending that's taking place right now are those that are deriving interest income from the $7 trillion that are sitting in money markets right now.
All right, so let's talk about what you just mentioned as far as the dollar is concerned. And, again, I just mentioned it can't get out of its own way. It did have this rally, I want to say, this is the U.S. dollar index, the Dixie, from multi-year lows in early July. I want to say somewhere around 97. It got as high as a little above 100. Here we are now at 98 and a quarter. What are some of the ideas that you have in a weakening dollar environment? I know that you are a big fan of gold, but are there some other trade ideas that you have? I know that you're probably just reload on gold. Do you think if the dollar were to make new lows, we're going to see gold make new highs? And what are some of the other ways that you might express that view?
So to me, there are a couple of great plays to position oneself for a weaker dollar, and that's what I'm doing. Long, in addition to the precious metals, and not only gold and silver, but platinum too, we're long the miners, and gold miners are finally playing catch up to the price of gold because people are realizing the very fat margins that they have right now with their all-in sustainable cost around $1,400, maybe $1,500 tops, but with almost a $3,500 price of gold. But very bullish on ag. Ag stocks, particularly the fertilizer stocks, have really sucked wind here. And anybody looking for cheap, out of favor stocks, when I invest in commodity stocks, what I love is companies that are still profitable, generating free cash at the bottom of a cycle. And when you look at corn prices at $4, when you look at soybean prices around $10, those are depressed prices for those two crops. They are very highly correlated with the price of potash and phosphate and nitrogen. And Mosaic and Nutrien are great plays for what I think will be an eventual rise in those prices. Interestingly, there's been tremendous demand for fertilizers, but the price of fertilizers have been relatively low because of those crop prices. But also love energy prices. I think $63, $64 price of oil is dirt cheap, particularly on a real basis, where we've seen a multi-year low in rig counts. We haven't seen that much of an increase in supply, even with OPEC increasing their quotas, which tells me that all those quota increases we're doing were just meeting up with existing production. So I think oil prices at these levels is dirt cheap. And a lot of these oil companies are very profitable at $65, particularly the senior ones, Meanwhile, the smaller shale guys, they keep putting down rigs because it's harder and harder for them to make money at these prices. So again, if you can buy a commodity stock in a company that is generating free cash in a low price environment, that is a perfect setup for them to really generate a lot of cash when the prices eventually go higher. Also, finding still a lot of attractive stocks in overseas markets, in Europe, in Asia, and also just boring stocks like Nestle, Veolia Environment, Universal Music, all benefiting from the weakness in the dollar and also a global presence where they're multinationals, just like we have multinationals here. And one other thing that's worked out pretty well for us so far this year, and with this weakness in the dollar, is having emerging market local currency sovereign bonds. And whether that is in Mexico, Brazil, Indonesia, this weakness in the dollar has really helped that trade. And we're getting low to mid double-digit returns with the weakness in the dollar and also good coupons. And with these coupons still well above what we're seeing in the developed world.
All right. When you said boring, I'm going to put that last one is the most boring and the least likely for me to figure out how to own, just to be really clear on that. But let's walk back here. Okay. So let's talk about the ags. You mentioned Mosaic. The stock in the lows in 2020, the COVID lows, was $6.50. It was down from the 2018 highs of about $39. But then from those 2020 lows, the liftoff, it nearly went to $80. What the hell was going on there? Because right now we're at 33 and we just rallied, I want to say, from the mid 20s or so. Help me understand this stock, because it looks like one of these generative AI names from the lows in 2020 to the recent highs in 2022.
And if you took that chart even back further, in 2008, when commodity prices topped out, this stock got to $150.
Oh, wow. Okay.
So quite a yo-yo. The acceleration to $80 in early 2022, and we had owned it going into this, obviously not having any idea what would happen, but it was Russia's invasion of Ukraine. And with Ukraine being the global breadbasket and the fertilizers that they produce in addition to Russia, crop prices spiked, fertilizer prices spiked upon that invasion. We were fortunate enough to sell it into that rally and really got back in at the end of last year when those stocks got hammered, because then we realized that Ukraine's, at least on the farming side, the crop side, and the fertilizer side, that there really wasn't any disruptions in terms of delivery. So that's why those stocks then have tanked since. But down here, you want to buy commodity stocks when they're beaten up, and you want to sell them when everybody loves them. And now I think they're still pretty beaten up. Mosaic reported the stock got hit after that report because there's some execution issues with a few of their phosphate facilities in the U.S. But I do think, again, a corn at $4, soybeans at $10. This is a cheap way of playing those crop prices.
All right, let's talk gold miners for a second here. You know, the GDX, it's had this monster move. Are there names within that ETF that you prefer than owning a basket of them in an ETF like the GDX?
Well, the two best is Agnico and Alamos Gold. We own GDX. We actually also own Agnico, but those stocks have had nice runs. But I think you're in a phase where if gold prices accelerate from here, if this weaker dollar does play out and gold's a beneficiary of that, then you can even start buying anything that's gold related and even into the juniors. So we also own GDXJ to capture the juniors as well as the seniors. Newmont has been a perpetual disappointer, to use that word if it even is one, but we do think that there's potentially a lot of upside there because it actually is in the S&P 500. If you do get eventually a lot of generalists that say, I need to buy a gold stock, Newmont's going to be at the top of that list. So that's another one that I think people should take a look at. But I mean, GDX is back to where it was in 2011 when gold was 1900. Now, granted, costs have risen a lot too, but to show you how difficult the mining business is, but also on the flip side, when you get a big margin spread like we have now, there is a lot of potential upside. And GDXJ, which is about, I think, $65, $70, this thing was $165 in 2011.
Yeah.
So again, costs are much higher now than they were then, but I think it just points to there's still a lot of upside in this trade.
Dollar week, crude oil week. You just mentioned names that can be, or you didn't mention the names, but you kind of hinted at stocks that can operate in this environment well. This is the time that you want to be buying. What are some of the names within the energy space that you're looking at?
So as a way, and also this goes for the weaker dollar, as a way to play both the weaker dollar and higher oil prices, we own BP, which has just been an awful, awful stock. The stock is still below where it was pre-COVID, but a lot of change is taking place there. You have multiple activists involved, pays a great dividend yield. I think BP is dirt cheap. We also own Shell, which has done much better because they've executed tremendously better than BP, but also you get the benefit of a stronger pound relative to the dollar, as both companies are domiciled in London. And also we own Canadian Natural Resources, which is a high quality oil and gas company based in Canada, where you also can play the strength in the Canadian dollar relative to the US dollar. So those are three ways, but then also some ancillary ways. I'm very bullish on Noble. One of the characteristics of US drilling right now, and you're seeing that I mentioned earlier in the rig count, is that shale in a lot of the key basins, or shale drilling or production, I should say, is rolling over. There's some people that believe that even the Permian is beginning to flatten out, and that would mean that there is going to be more drilling offshore, which would benefit companies like Noble, who have rigs that are solely dedicated to offshore, both deep water and shallow water. Pays a great dividend yield. There was insider buying back in April and May when the stock got puked into the high teens. So that's another way of sort of touching the oil and gas sector in a picks and shovels way.
What about regional banks here? They're having a day, and they really, I think, outperform small caps definitely over the last, call it, few months from the lows in April. Yield curve 210, it's kind of stuck here. It's 57 basis points or something like that. So we're not seeing a large move one way or the other. Thoughts on regionals, because the KRE is trading at 6-month highs right here and it's breaking out.
I think investors are loving the possibility of lower funding costs. We know that, if I'm Bank America, I can charge you 0.2% of interest on your savings to me. But if you're a regional bank, you need to compete for a variety of other reasons against other regional banks and even the money centers for the services that are provided. And you need to charge maybe more, particularly more also on your CDs. So the possibility that these regional banks can have lower funding costs via a lower Fed funds rate, I think is really benefiting them. Now, at some point, though, if people sort of flip the script and say, well, if the Fed is cutting interest rates because the labor market is deteriorating, well, what does that mean for my loan book? What does that mean for my delinquency rates, both at the consumer and also at the business level? That's going to be the offset to those lower interest rates. I think a lot of people in the markets forget that when the Fed was cutting interest rates in the early 2000s in response to the implosion of the tech bubble, the market kept going down because lower short-term interest rates was not the cure to the popping of the tech bubble. Just as the same took place in 2008, 2009. The Fed started cutting in September 2007. The stock market hit an all-time high in October 2007 and then proceeded to fall 50% in the face of everything the Fed did to try to save it. And I'm just painting a scenario here, Dan, for a second, so you hear me out. If the economy plays out over the next year or so, where the AI spend just slows down, if that incremental benefit from that trade and that impetus to the economy starts to slow down, at the same time, government spending growth is beginning to slow, and that impetus to economic growth starts to slow. And if this all of a sudden affects the stock market, cutting the Fed funds rate is not going to regenerate data center buildouts. That reversal of that is going to happen irrespective of Fed rate cuts. So I just think that investors, instead of blindly thinking that Fed rate cuts are going to solve every problem that comes our way, should just refresh the textbooks and the history books on what happened while they were cutting interest rates and the two previous recessions prior to COVID.
Yeah. All right. Last thing here, and I appreciate that on the data center build and the capex spend, and it really obviously has represented a huge part of growth or GDP growth over the last couple years or so. The question I have about the financing of these data center builds, it's getting to a point where, these companies, these massive hyperscalers, the Google, the Microsoft, the Amazon, Meta, OpenAI, they have shit tons of money. OpenAI is different because they lose a lot of money, but they have not had a hard time raising money. So these companies have been funding these builds, obviously with their CapEx, but now they're actually raising money in the private market, if you will, right? So private credit companies are putting up a ton of this capital. And I read this morning, it was in the information, that a lot of this debt is actually going on the balance sheets of the data centers, not of these large mega cap companies. So what do you make of that? Because it's interesting. It looks like this is a little bit of a shell game.
Yeah, so they're setting up these special purpose vehicles that will itself technically raise the money. So let's take the Meta project. I think the Meta project is $25 billion, one data center, even though it's massive, of course, and that is going to raise the $25 billion. So Meta is not obviously then going to have to put that on their own balance sheet. Meta is essentially going to be a tenant of that project. It's reminding me of what we saw in the cannabis space, where you had a lot of private money go into building out and owning the warehouses and then leasing it to the growers. Now, Meta, from a balance sheet perspective, okay, they're protected by it. And if you are a lender or an equity holder in that facility, you say, well, Meta is a great tenant. They're going to pay me back. Yes, of course. But you wonder with the pace at which technology obsolescence takes place, is what's the value of this piece of property at some point down the line. But yeah, it is an interesting way of financing this build going forward. And but you know better than me, Dan. Is the math being done in terms of somebody trying to figure out, these are our compute needs, this is the build that's taking place, and is there going to be a mismatch in the next couple of years?
Well, there's a great note that a friend of Porter Collins and Vincent Daniel, a guy named Cuppy, it starts with a K, and we'll find it. He wrote this last week. I think it was like a Substack, and he did that math exactly. And there is a huge mismatch, especially when you think about this report that came out from MIT last week. Did you see this? And we'll put a note about this saying that 95% of the respondents to this survey who are using generative AI co-pilots or the like, these are enterprises, are not getting a return on their investment. Now you could say this is really early, okay? And that number almost sticks out like a sore thumb, where it's kind of not believable. I think a lot of these folks who are maybe responding don't really know what they have just yet, right? But the point is that we've seen this massive build. We've seen hundreds of billions of dollars, maybe close to $1 trillion just over the last 3 years. There's a lot of expectations that in the next 3 years, there's going to be $3 trillion in spend, right? So unless you get massive enterprises getting some sort of return on investment, there's going to be less demand for that compute, right? There's going to be a slowdown in CapEx. There's likely to be a price war. You're going to see companies like CoreWeave that were conceived basically for Nvidia to sell their GPUs, to sop up some of this excess demand, right? And you saw massive customer concentration at a company like CoreWeave because Microsoft were 70% of their revenues when they went public back in March. I mean, you can see how this whole thing comes apart. I don't mean disaster, but when you think about 2000 and you think about the internet bill and the fiber bill and all that sort of stuff, it didn't take much for things to start to snowball. There was a lot of vendor financing that was going on, right, from the Sun Microsystems and the light and Exodus Communications. People forget that. That was a data center company to fund the build out to be there. So then companies like Exodus Communications, which existed to be the backbone of the internet build, and we could talk about the fiber and the Lucent and the Nortels and all that sort of stuff and Global Crossing. There were plenty of names that got absolutely destroyed. It's not too different this time, to your point. I don't think it would take too much to kind of flip that switch. But again, people like me have been suggesting we're going to go into a digestion phase every quarter for the last few. Let's see what Nvidia has to say. There's going to be a quarter with Nvidia where it's just not good enough, right? And it starts something that's very different than happened from the highs in February to the lows in April. And again, I think that was more, let's sell the things that we can that have big gains. But if there's a fundamental reason to sell these things, I think it's going to be really different. But the prior time, so thinking about fundamental things, let's talk about DeepSeek. We got to go all the way back to late January. Obviously, a lot of this Nvidia export ban to China and using the H20, which is a scaled down version of their Hopper chip. What's your take here? Because I know you and I were going back and forth a little bit offline over the last couple of days. The idea that, our companies with the best technology, it's not just from a hardware standpoint, but Nvidia with the CUDA software, we might as well get the Chinese companies who are building these models, and theirs are largely open source, hooked on our technology, because it's just going to put us in the driver's seat, not just between the two of us, the China and the US, but also, let's just say, around the globe. Because if these guys are able to innovate and do it cheaper, then that means that they can undercut our technology in a whole host of different regions, which might put us in a worse off place than now having the lead in AI.
Yeah, so I'm going to rewind the clock, because this really started when under Trump 1.0, when they almost took down ZTE, and they were ready to deprive them of key technology products that they used from the U.S. companies, to the point where this company was going to go down without any relief. And China said, well, we need, over the next 10, 20 years, we need to create our own technology ecosystem and not be reliable on U.S. technology anymore. And we sort of facilitated the progress that China has made by limiting their access to our chips and other technology products. Now, I understand from our perspective, well, we don't want to sell China tech products that they're going to use in their military, whatever. But, I was always fearful that all we're doing is, stoking them to create their own technologies. And that's exactly what we've done. China has advanced tremendously, particularly over the last couple of years, in technology in a variety of different areas, in software and AI and certainly chips that have driven that AI to the point where they've created these models that are just as good as ours. You mentioned DeepSeek, and now I'm learning about Alibaba's, and Tencent's got their own, and Baidu's got Ernie. I mean, there's a variety of them. So what I think people should be thinking about is, up until this sort of China resurgence when it comes to technology generally, and particularly the areas that we're talking about, is U.S. tech dominated in every aspect. We were the global innovators. And yes, to an extent, China is the global imitator, but they're taking that imitation to such an extent that they are now a major competitor of ours in a variety of different product lines. So when you look out over the next 5 to 10 years, and it's take that Asian company, that startup in Singapore, that's bootstrapping a business, that needs to build out their IT department, and they have choices of who to buy their tech equipment from, who to buy their AI models from. Well, for the first time, China is going to be in that conversation. China is going to be a big competitor to ours, and chances are, in certain aspects, are going to price their products cheaper than ours. So we're still going to be dominant. We're still going to have great technology, but you start to lose those deals here and there, then all of a sudden, this is much more of a multipolar technology competitive world rather than just U.S. companies dominating everything.
Yeah, I mean, you say that, Peter, but we don't actually have any evidence over the last 50 years where China has actually out-innovated us. You know what I mean? And I get what you're saying, as far as the open source models and the hardware technology that they can provide and do a digital belt and road, if you will. But it hasn't happened so far. So I just don't know
Yeah,
why.
and it may not.
Yeah, I would just be more concerned about the way in which they might be able to innovate with our technology that will find it into their defense and intelligence apparatus, that sort of thing. And when you think about this trade war that we're in right now, it really is coming down to their rare earth materials and our high-end, chips that train generative AI models. And that's the leverage that we have right now. So if you're a CEO of a company like Nvidia, that is the most highly valued company on the planet at a $4.4 trillion market cap, and you are willing to go into the White House and give them a VIG on, let's call it the $20 billion, in sales that you will have to Chinese companies that will find themselves in the CCP, however they back, their companies. I think every day of the week you say, Jensen, sit down. We got this one. You know what I mean? Like, you know what? I'm sorry that your, $4 trillion in market cap gains in the last 3 years is not enough. You need to sell $20 billion of your shittiest chips to China. You know what I mean? Like, I don't know. That's my take. And there is a sense of irony that you go back to Trump 1.0 and you were talking about ZTE, which is basically their Cisco, right? Like, we should do everything in our power to thwart their advancements. And it doesn't, in my opinion, that doesn't mean give us our best technology. They're going to use that technology for cyber warfare against us. You know what I mean? So I don't know. You and I could debate this probably for hours.
Yeah, strategically, I completely understand that. My fear was more of all we're doing is further incentivizing them to do this themselves, to the point where
what further incentives do they need other than this bipolar world that we live in? They've been in a tech race with us for 50 years. So, like, to me, at least we have a lead right now. We have the best talent on the planet. I hear this. I hear it all the time. 50% of those developers, as far as generative AI, are in China. Well, they still don't have a lead on the best models here from OpenAI and, the likes of Gemini. And I mean, the list goes on and on. So I don't know, man. I get it, but,
we'll still be the most dominant, I believe. I'm with you on that. My point, I guess, is more of if we're just a little less dominant, if we have less market share than we have now, then that's a big deal. Instead of, and call it an 80% market share in a certain line of software or chips, that market share is 50. I think, using Nvidia as an example, I think their market share was 80 plus and down to 50. Just on the margin, if we start to lose market share with this big competitor, even though our stuff is better in the aggregate, just something that investors need to think about when they value big cap tech and they're looking out over a 5 to 10 year time frame.
That's fine. Baidu in China, they have supposedly a very good Gen AI model. That company has a $9 billion enterprise value. Okay. It is so cheap. Baba is so cheap. These stocks are down 80% from their all-time highs just 4 or 5 years ago when their own government cracked down on them. So I'm not worried about Alibaba and Baidu like out innovating us. And I know there's probably some companies that we haven't heard of. So again, you and I could have this debate for a very long time. Let's end it here, Peter. But I really do appreciate your insights, your idea generation. And I don't hope, you will be back next week. So we appreciate it. Thanks so much, Peter.
Thanks, Dan. Great being with you.